We are live. Let's figure out how to turn off this this music. Maybe Tanishka can help us with that in a second. But Moni, what am I seeing behind you? It looks like the moon, but I think it might just be a reflection of a light.
It's definitely the reflection of a light.
Since you're 3 hours earlier than I am, I assumed it wasn't the moon. But
yeah, no, that is you're getting a live view of of the lights from the Las Vegas hotel.
Great. Is it 11 a.m. there? I can remember if Vegas is Mountain Time.
It is Pacific time.
So you're not. It's not too early, I guess. You put something on my calendar for 6 a.m. your time tomorrow. I was gonna let you off of the hook of doing that call, but I guess we can do it if you want. When I was there last year, I definitely was not getting up at 5:30 a.m. But we can. I guess we'll kill another 45 seconds before we get started. But as usual, as people start to filter in, I'll just say thanks for joining. Put in the comments who you are, where you're from. I'm sure, as usual, we'll see a bunch of familiar names and locations, but it's always good to hear who we're talking to, so we have a sense of how to talk about this stuff. So put that stuff down, and we'll get started in 15 or 20 seconds. Mon, did you hit the poker rooms or anything like that last night? Just getting work done.
No, and for the just getting work done. For context, I'm in Vegas for a solar conference, and so it is. It's been mostly work and meeting folks. But yeah,
I when I was there for 4 days, I kind of assumed at some point I'd get sucked in, but did not, and just got things done.
Yeah.
All right. Well, it's 2:02, which is the customary time where we jump into this stuff. So let's do it. Welcome everyone who's joined so far. I see the numbers ticking up pretty quickly. We are here today for, I think, the 40th, big round number, the 40th in our weekly or bi-weekly series here on the various aspects of tax planning that Valur can help with. We're talking about Spigot NIMCRUTs today. The last few weeks, I think, Moni, I don't know when the last time you did one of these is, but I feel like the last few weeks we've kind of taken a step forward, and we're really talking about the next level of optimization, right? For the first 10, 12 of these things, it was, what is tax planning? What are capital gains? Maybe what is a CRUT? The next, 10 or 15 were, okay, so we understand these big picture structures. Let's do some case studies. Let's talk about who they're for. Now we've talked about rolling grats. We've talked about swap powers. Here we're talking about Spigot NIMCRUTs. This is now for the reasonably advanced user. How do you optimize this stuff? How do you get every last dollar out of what Valur helps with? And so that's the goal today, is to talk about this particular strategy, which is an extension of something that a lot of you and your clients and our clients are doing, which is CRUTs and NIMCRUTs in particular.
Yeah, and the piece I'd add there is like really kind of our, and this is probably a nice transition. Our goal at Valur is, and this started with kind of my own scenario of I worked for a startup, it IPO'd, that had the joys of living in California, good and bad. Bad was probably on the tax side. And really started with, everyone hears stories about how this billionaire or that billionaire legally avoids taxes. And it's mostly the social commentary, whether it's the New York Times, Wall Street Journal, ProPublica reporting on it. My thesis was, if they're doing it, why can't I? And, coming from, there's all these barriers today. It's fairly hard to access. It's hourly, it's high cost. You're not sure the quality of it. And really the approach that we come from Valur is we want everyone to be able to access these best practice tax mitigation strategies, whether it's ordinary income, capital gains, or estate taxes. But the level we really want to go to, and this is kind of reflected in today's content, is we want to kind of come with the precision and the scientific approach of how do you get the most out of these structures? It's not just what is the basic thing, but how do you get the most? Because, basics of any finance, or which tax is tied to, is it's about compounding. And so these really small optimizations really add up over time. And that's our belief, is everything, no one does taxes for fun. You're doing this for financial returns. And our job is, how do we get to the level of precision and kind of quantitative idea to help you understand how do you get the most out of this? What are the real trade-offs to come to the best decision? And also use technology to make this more digestible, acceptable, accessible, and optimized.
And to build on that, making this quantitative, which really takes away the friction and the kind of mental load of making all of these decisions. I think one reason why a lot of these optimizations are not in the collective consciousness or not on people's radar. Very often you'll talk to a lawyer who does CRUTs and you won't even hear about these things. And the reason why I genuinely believe is not that these lawyers aren't smart enough, although some of them aren't thinking that hard about this, but mostly it's they don't know whether a standard CRUT is better than an NIMCRUT. They don't know at what point in the life should a flip CRUT flip to optimize returns. And because they can't answer that question, they just don't get into it and they keep it simple and they offer you a 20-year standard CRUT. And that is not optimal. And our goal is to give you the tools and for us to have the tools to get you those answers so you can make the right decision. And what you'll see today is that very often that right decision is an NIMCRUT and specifically this Spigot structure that we'll talk about. So the agenda for today, which we've already previewed, is to do a little bit of remedial work so that everybody's on the same page about what charitable remainder trusts are and how they work. There's some basic understanding that I think most of you probably have, but we need to make sure everybody does so we can then scaffold and build up to this particular optimization, the Spigot NIMCRUT, and how it works. We're going to talk about the Spigot NIMCRUT as it compares to regular NIMCRUTs, as those compare to standard CRUTs, and as all of this compares to doing no trust planning at all, which is, of course, the baseline that most people are coming in with when they first talk to us. And then we'll really get down into the nitty-gritty and talk practically and tactically about for whom and when does a Spigot NIMCRUT make sense. And one way we'll build that case up is with a quantitative look at a particular very common user that we have.
Yeah, and the piece I want to call out there is what we're really framing of putting this in a quantitative point of view is what is the value of, again, as Jeff called out, of compared to doing nothing. There are other trade-offs, things that you have to understand with the structure. And so what we really want to frame is what is the upside of using this structure? And does that justify you learning more or potentially using it? Because, if there's not enough financial upside, it may not be worth your time. And so this is where we built tools to make that easy to understand. Is that financial upside exciting, worthwhile? And if so, then it's worth learning more.
That's right. And I think that also that's kind of related to what I talked about at the outset, which is that we're scaffolding up and we're building to the more complex planning. There is a whole world, an infinite long tail of strategies or even optimizations of a strategy that aren't going to make sense, that aren't going to have the ROI to justify the cost, the complexity, the mind share. What we're doing is bringing you the ones that we've decided we think are that valuable. And for many people, and we'll talk about who, are worth the effort and the potentially kind of complexity. Although, as we'll talk about, Valur takes a lot of that complexity away, which makes it much easier to justify pursuing some of these advanced strategies.
Yeah. As we get started, I'd just say, as you have questions, just put them in the chat. We'll try to either address them in real time or save them to where it's appropriate. But we want to make sure this is valuable to you. And so let us know what is most valuable to you.
Yeah, that's right. Even if it's the simple stuff, hey, I don't get this feature of basic charitable remainder trust. It's really important stuff to build up to the more complex. So that's where we'll start. We're going to start with what is a charitable remainder trust? Again, most of you know this, but very quickly, the idea of a charitable remainder trust or charitable remainder unit trust, CRUT, is that this is an unlimited tax-free account from which you can distribute to yourself and pay the taxes, and then eventually leave some money for charity. The way it works at a more fundamental level is you take some asset. Let's say you own some Apple stock that's appreciated. It's grown 5x over the years. You bought it at $100,000 and now it's worth $500,000. And you're ready to sell. You're ready to diversify out of that position, and you realize that if you do so, if you live in one of the high tax states, or really even if you don't, you're going to owe a substantial portion of that capital gain in taxes. Let's use a round number of $1 million of gain. If you just sell naively out of your own taxable account, you might owe $250,000, $300,000 of tax on that sale. Instead, what you can do is take those assets and place them into a charitable remainder trust. The first thing you get out of that, which is a very small thing, and I always hesitate to get distracted by it, but you get an upfront tax deduction. Typically, that's around 10% of the value of the assets. Small thing, you put $1 million in, you're getting about $100,000 deduction. It's not nothing, but it's not the main show. It's not the reason to do this. The reason to do this is that when you put that $1 million of Apple stock into a charitable remainder trust and then sell it, you pay no tax when you sell. And so again, instead of sending a quarter or even 35% of that money to taxes, you get to keep the full proceeds, the full $1 million, and you get to reinvest however you want, with a couple of very narrow nuances that are outside of the scope today. You can find more about that on our learning site. But you reinvest the money, you grow it over time. You're entitled to annual distributions. We'll talk more about how exactly those are calculated and what the rules are, but you're entitled to annual distributions. You can take them very often, you can defer them, and that's part of the spigot that we'll talk about. And then you do that for a long time. Maybe it's a fixed term, maybe it's a lifetime trust, maybe it's even longer. But ultimately, you're taking distributions, you're paying taxes, you're deferring the tax until you take the money out. You leave something for charity at the end. And by doing that, by deferring those taxes for potentially many, many years and compounding tax-free, a lot like a traditional IRA, you end up with a lot more money after taxes at the end, even after leaving that charitable gift. And so I've captured the benefits and trade-offs here just in talking about that. You're deferring the taxes, you get that upfront deduction, you're spreading out your income, and so you're paying lower marginal tax rates. The trade-off is that the money, you're entitled to an annual distribution, but that is capped. And so you couldn't just drain all of the money out of the trust at once, and you are leaving a big chunk to charity. Although again, we can show in the modeling that charitable gift doesn't really do anything to significantly reduce the overall return.
Yeah, and the way I'd frame it is, right, is you're deferring, because the trust is tax exempt, you're able to, when you sell these assets, again, this only makes sense with appreciated assets, you're able to defer the taxes on that you would otherwise owe, and those deferred taxes get reinvested and create more wealth. If you would have paid $500,000 or $300,000 in taxes, that money would have been lost, but if you invest that creates more money. And over time, to Jeff's point, some of that money is going to charity, and then you're getting most of that money, and then you're paying taxes on it. But the idea is that is money that would have otherwise been lost. And even though there are some going to charity, you're getting most of it. And that is, free money is the wrong framing, but it's money that otherwise would have been gone. And this is why, and this is why it's, it's like, what do you think about who uses these, right? This is everyone from, we have interesting data and we're going to later release that this year, but this is everyone from Phil Knight uses this with Nike shares to historically, these structures have been, the median size of these historically is north of $20 million. We obviously see a lot smaller because we've made this more accessible. Historically, it's been hard to access. You typically pay a lawyer, north of $10,000 for this, plus a trust company a lot. We've dropped this cost, the friction, so it's a lot smaller. But these are, historically, this is one of those structures that you don't hear about as inaccessible, but used by the very wealthy to reduce taxes when selling appreciated assets.
It's funny, you started that discussion with basically just explaining compounding, which I remember the first article we ever wrote after kind of the initial kind of false starts. Our first CRUT article, you told me we really need to explain compounding in this article, and it just reminds me that this stuff isn't always intuitive. A lot of folks just haven't thought deeply about this. It's really important to build up the fundamentals. The whole point of almost everything we do is compounding in one way or another, right? Getting more money into the system and letting it grow over a long time. That is the bottom line with almost all tax planning. Of course, there's nuances, there's estate tax, there's all kinds of things, but more money for a long time is good.
Creates even more money. Yeah, creates exponentially more money.
Yeah, that's right. The chart gets very big. So with that in mind, in order to build up to the Spigot NIMCRUT, we do need to talk about a little bit about the nuances here. What are the different formats of NIMCRUT? So Mani, you want to talk about each of these?
There's three types of basic CRUTs. There's the standard CRUT, which is also known as a SCRUT, a NIMCRUT, and a flip CRUT. These legal structures, they love kind of complicated acronyms. The standard CRUT is the simplest. What this means is for any type of CRUT, you have a set payout percentage every year. And so that percentage is typically somewhere, let's call it between 5 to 15%. But what that means is, let's say it's 10%. With a standard CRUT, every year you get 10% of the trust assets. And that number isn't a set dollar amount, it's a set percentage. So if there's $1 million in the trust and that payout percentage is 10%, you get $100,000. If the next year the trust is worth $2 million on December 31st, you're getting $200,000. And so every year it's a set percentage. You can't defer those distributions. You can't increase them. It is unless you increase the value of the assets in the trust. Every year you get that set percentage.
So that's a very simple, predictable, standard way to do this. And Monty, fair to say, before Valur came around, I think you've dived into the data more than I have. But before Valur, standard CRUTs were standard. They're called that for a reason. This is the lowest hanging fruit. It's the easiest way to do this. It's what the lawyers did, and it's fine, right? It is positive ROI. We can show that with the modeling, but there are ways to do better, right? Again, especially if you're thinking over the long term and optimizing, right?
Yeah, exactly. And this is it's 100% right. And this is where it tends to make sense for people who want consistent distributions. I'll explain why. You want the consistency of, it's not a set amount, it's a set percentage, but it is, you don't have to want to worry about complexity, or you don't have to worry about, will I be able to pull money out this year? That's when it makes sense. Now, there's a question that I'm seeing in the comments of, at what time is that payout percentage set? Is it applied at the time of distribution or another time? It's set up front when you create the trust. So this is when the trust is created. It's based on how long the trust is set up for, essentially inversely related. The longer the trust is expected to last, the smaller that distribution percentage is. The shorter the trust is expected to last, the higher that is. So as an example, you can set these charitable remainder trusts up for either a set number of years, between 2 to 20 years. You can set up for people's lives or multiple people's lives, or a combination, such as a longer of just life or 20 years. Now, as an example, if you set up a CRUT for 20 years, the payout percentage is about 11% per year. If you set up for 10 years, it's about 21% a year. And that's where kind of it's inversely related of the length of the trust and the payout percentage adjust to each other.
But you are deciding it at the outset. And that's, by the way, why the structures we're going to talk about today are really useful, because you do have to pick the number on day one. But if you have these other mechanisms to potentially shield or reduce the distributions, you do gain a measure of control over how much is coming out every year.
100%. Now, the standard CRUT, you're not knowing the exact amount, but you know you're getting a set percentage every year. The NIMCRUT, on the other hand, you still have the payout percentage. And by the way, if you set up a standard CRUT, a NIMCRUT, or a flip CRUT for 20 years, it's the same payout percentage. So that payout percentage is tied to the length of the trust, not the type of CRUT. The NIMCRUT, so NIMCRUT stands for Net Income with Makeup Charitable Remainder Unit Trust. It's a mouthful. Here's really what matters. The trust pays you the lower of the trust income or that payout amount. So take the scenario where the trust is worth $1 million and that payout percentage is 10%. The standard CRUT would pay you $100,000. The NIMCRUT will pay you the lower of the trust realized income, so not unrealized gains, or that payout percentage. So let's say there's only $20,000 of realized income in a given year. The NIMCRUT will pay you $20,000 that year instead of $100,000. Now, you're like, why would that be good if I could only get $20,000 instead of $100,000? The NIMCRUT, what happens is if it pays you less than what it owes you, so that $100,000, that underpayment, in this case $80,000, goes into what's called a makeup account. It's essentially accruing what it owes you. And so after the first year in the NIMCRUT, you'd have an $80,000 makeup account. And let's say in year 2, the trust goes to $2 million. But let's say there's no income. Now the trust, again, owes you 10% of that, so $200,000, but has zero income, so pays you $0. That $200,000 gets added to the makeup account. So now it's $280,000. Let's say in year 3, everything is sold in the trust and there's $1 million of income. So the trust for year 3 owes you 10% of $2 million. So $200,000 plus the makeup account, which is $280,000. The trust owes you $480,000 and there's $1 million of income. The NIMCRUT pays you the lower of the income, which is $1 million, and what it owes you, $480,000. So in year 3, you get a $480,000 distribution. Now, the power of this is, the power of CRUTs broadly is you get to defer taxes, reinvest that money. And as we're talking about compounding, the longer your assets can grow tax-free, the more wealth that's created. The standard CRUT, you're forced to take distributions every year. And this is not good or bad. It means you can get consistency of income, but you can't defer distributions and defer taxes. The NIMCRUT, you can actually kind of control distributions to some extent and defer distributions and defer taxes. And so this is where the positive is you can get more after-tax returns because you get more compounding, more tax deferral. The downside is you need income to be able to take distributions. And so this is where if you want consistency of income, it may not make sense. But if you don't need if you don't think you'll need money every year, or there's specific years you'll want it, but then the NIMCRUT can make sense because you can defer that income, defer the realization, and take larger distributions and get more tax deferred growth.
And we'll talk a little more about when each of these things make sense. But in general, Monty's right. Kind of empirically, over the very long run, a NIMCRUT's going to be higher return, and the reason for that is that you do get to compound, you get to leave the money in there to grow, and over the long run, your assets go up in value, right? I can't promise that forever, but historically, for a very long time, stocks have gone up, crypto has gone up, other assets have gone up, and so over the long run, a NIMCRUT's going to be higher value, right? And that's why almost all of our young clients and even many of our kind of older clients do end up choosing a NIMCRUT. The last one, and we're already halfway in here, so let's maybe just kind of speed through. But a flip CRUT is really just a combination of the two, right? It behaves as a NIMCRUT for a certain period. I don't think we need to get too deep into what that trigger is, but basically for some period, it behaves as a NIMCRUT, and then it flips, it turns into a standard CRUT. And this is really just a way to get the benefits of both worlds, right? You get to defer for a number of years as a NIMCRUT, and then you get the certainty of payouts in maybe retirement or as you get older.
100%.
Out of standard CRUT.
Yeah, just to hit on that last part. The flip CRUT's really the use cases. You don't need consistency of income up front, so the NIMCRUT piece, but at a certain point you do want it. So this is post-retirement or something else.
Very quickly, Elizabeth, this is an easy one. Well, there's a whole can of worms here, but the answer is reasonably straightforward. Distributions generally retain the tax character that they had inside of the trust. So if you sell off long-term gains, for the most part, that money, when it comes out as distribution, will be taxed as long-term gains. The complication, and I'm not going to go into this really at all, but if you want to go to our site, again, learn.valur.com, you can check out an article on 4-tier accounting. This is the idea that the trust has to pay out the highest taxed income first. And so there's a little bit of complexity to it, but in general, these trusts retain the income retains the character it had inside the trust. So for the most part, you're paying long-term gain rates on what's coming out of a CRUT. I'm actually going to maybe jump through this one really quickly. Monty, you talked about the nuances or the format of a NIMCRUT. As you said, it pays out the lower of those two numbers. In years where the payout is lower than your entitlement, the amount rolls over, it adds up. Overall, it'll generate better returns than a standard CRUT, assuming that the assets go up over time, which historically they have. Yeah. But the downside is that, number 4 is the piece that we haven't really talked about yet. Not only is it the case that a NIMCRUT doesn't have to distribute, but if it doesn't have the income, but if it does have the income, it does have to distribute. That's the flip side, right? There's just a formula. The formula is the lesser of, it's a minimum function. It's the lesser of the amount you're entitled to or the income. What that means is if you're entitled to some money and you have some income, you have to pay yourself out. And that is where we're about to pivot to spigots, because for many of our clients, and I think for many of you, there might be years where you have income from dividends, from rebalancing your portfolio. Maybe you took some gains because you thought you were at the top of a cycle. And you'd be forced to distribute out of a NIMCRUT. And that's not ideal because you're then forced to pay the taxes on those distributions, to Elizabeth's question. And those taxes eat into your compounding. And so if there were a way to avoid those forced distributions while still benefiting from the deferral of a NIMCRUT, that would be ideal.
Yeah. And just to hit on this just a little bit more. So typically most gains and appreciation is tied to either dividends / yield, interest, or appreciation. In most cases, you can't control dividends, yield, interest. And so this is the stuff that essentially think about as like a flow through. It's going to get realized in the NIMCRUT and it'll pass through. Now, typically in most cases, you have control over the appreciation or capital gains in that sense. And so this is where you can choose and in today's world, most of these gains are capital gains. So you have control over most of the distributions when you sell it. Now there's some scenarios, selling a company, things like that, you may not, but that's the idea is in a standard NIMCRUT, you can control the capital gains when those get distributed and when you pay taxes, but not on the interest dividend yield.
One thing I want to add there, Monty, though, is we hear very often from clients who are sitting on capital gains of the kind that you're describing as totally controllable, which, strictly speaking, you're absolutely right. You can decide when to sell your Apple stock, right? No one's forcing you to sell, and no one's saying you can't sell when you want to. But it is absolutely the case that there are people out there, I suspect some of the folks on this call, who have at times decided not to sell their stock because of the potential tax hit. Or in a NIMCRUT even, they've decided not to sell their stock because they didn't want that forced distribution. And again, this is where the next step, the Spigot NIMCRUT, can give you even finer grained control over when you realize and when you take those distributions. So that's the point here. You can do better with a Spigot. We've been hinting at this. Let me just put a fine point on it. The way a Spigot NIMCRUT works is you have a NIMCRUT just like any other. It's going to pay out the lower of that payout percentage or the accumulated amount or your income. But what you do is you layer an LLC in between the NIMCRUT and the assets. So the NIMCRUT owns an LLC and that LLC owns the assets. And what happens now is, let's imagine that you've reached the point where you want to sell some stock inside of the NIMCRUT. Or let's say you've got a 2% a year dividend and you don't want that money to come out as a distribution. In a traditional NIMCRUT, it would have to if you had the amount to distribute. By adding this LLC, you're able to block that income so that the trust doesn't see it. And if the trust doesn't see the income, it's not forced to distribute. And so it's basically a NIMCRUT, but as long as the assets and the proceeds stay inside of the LLC, there will be $0 of net trust income, net accounting income. And as a result, the NIMCRUT won't be forced to distribute anything. So you have the NIMCRUT, you have the LLC owns Apple stock, you sell the Apple stock at a gain, but because it's in the LLC, the NIMCRUT doesn't see any accounting gains. And as a result, it's not distributing anything. Then down the road, when you decide it is time to take some distributions, you've reached retirement or you want to buy a house or you want to send your kids to college, you then take some of those realized gains from the LLC and send them up to the NIMCRUT, distribute them to the NIMCRUT. Now the NIMCRUT sees those gains, recognizes them, has accounting income, and distributes. So if you take $100,000 from the LLC and send it to the NIMCRUT, well, now the NIMCRUT has $100,000 of recognized income, and it'll distribute that $100,000. And so this is just a much finer tuned, more controllable way to decide when the income from the trust gets recognized and distributed.
Yeah. And the way to think about this is, and this is where the name Spigot comes from, is you get to turn on and off the faucet of when income gets realized. Before, the control you had was when you realize capital gains, and you don't really control dividends, interest, yields. But here it's effectively you get that control. You or kind of someone who's controlling the LLC, you get to say, hey, when does that distribute it? And it gives you that control there to control that. And as a result, you can get even more tax deferred growth, which again, all of taxes, all of finance really ties to this idea of compounding. And so over time, that all these kind of, it doesn't sound like a lot of dividends, interest. Why would you can really create more wealth, even more.
It adds up, and we are going to show you some numbers. But Dean just chimed in with a question, and I really appreciate Dean. We've talked a bunch. I appreciate Dean's ability to ask the right question at the right time. If this has all the advantages, why would someone not do it? That's a very good question. We're going to answer it right now. And the answer, I'll preview. The answer is, if you're going to do a NIMCRUT anyway, there are very few reasons not to do a Spigot. We'll talk about the cost and complexity, but the bottom line is, if you like the idea of a NIMCRUT, a Spigot is very often going to make sense, right?
Yeah, exactly. And this is exactly the entire piece is, when do you not want to do it, is there's fair. So one, it's like if you're doing an NIMCRUT, it does make sense in most cases. Now it's really, the question is like, do you want income from this trust? Or do you want to control when it happens? If you're like, hey, the difference in interest, it'll be nice that when it comes through, then maybe it doesn't matter. But otherwise in most cases it will. Can you do? There's a question here of another good question from Dean, and then we'll get to the. Can you do a Spigot flip CRUT? The answer is yes. And really, just to call out one piece is you could theoretically do a Spigot standard CRUT. It just doesn't have any value, because in a standard CRUT, it doesn't matter whether there's income or not. You have to distribute a set percentage of the trust assets. It's not limited to income. So you can do that. It's just not valuable.
I guess let me add. You could do a Spigot during the NIMCRUT period.
Yeah, no, that was where I was getting to. Is during the NIMCRUT phase of a flip CRUT, it would have value because you could control those distributions, defer them even longer until it turns into a standard CRUT. So the answer is yes.
Yeah.
Now, so that's kind of the short answer is you can do this with at any point. You can do this with any type of CRUT. It makes sense when it's a NIMCRUT. Particularly if you don't need the money or want more compounded tax deferral and growth there. Now, we've gotten this question a couple of times, so we'll just hit on it, I guess, one last time. There's a question of when you take distributions from whether it's a NIMCRUT or a CRUT in general, it is typically capital gains. Now, the reason I say typically capital gains is a CRUT is a tax-deferred structure. So what that means is the assets can be sold, reinvested, tax-free inside of the trust. But when you take the distributions, you pay the taxes that are the same as the type of income the trust the asset was. So if you sold the assets inside the trust and they would have been long-term capital gains, and then 3 years later, 5 years later, 10 years later, you take the distributions, you'll pay capital gains. And that's part of the work that we do is we do all the accounting, tax file. So, not to get into the soliloquy, like what Valur does, we help people understand these structures, set up these structures at no cost. We do all of that for free. We take care of the administration of these structures, help you optimize these structures, everything from the accounting, tax filing. And so part of this happens is when you take distributions, you pay the taxes that it would have been paid if it was, you would have paid earlier when you sold the asset. So if it was long-term capital gains, you'll pay long-term capital gains. If it was short-term capital gains, when it would have been sold, then you'll pay short-term capital gains. So it's not changing the nature of the income. It's not, if you'd held the asset for 2 years, when you transfer to the trust, it'll be long-term capital gains. So the most common, and so that's, hopefully that makes sense there. This is a tax deferral thing. It's not changing the type of income. It's allowing you to defer the taxes and reinvest it, and you'll pay that same type of tax when you pull the money out.
That's right. So we've really, I think we've hit the benefits here pretty firmly, right? It gives you complete control to defer the distributions, take them when you want, subject, of course, to having enough income to realize, to distribute, which we talked about. The whole point of this is additional compounding growth. So then to Dean's question, why not do this? The answer really is if you believe in it, and if you believe in Valur, then you should do it. If you're going to do a NIMCRUT, then you should do this. The only potential downsides are, as we have here. First, let me talk about potential IRS scrutiny. This is a small one. There's no indication that this is a questionable strategy. We just always like to make sure that you all understand that the IRS is out there, and theoretically they could look at this. Valur's never had any client audited. This strategy doesn't seem to have any higher audit risk, but we want to mention it. And then the other one, which also feels like I'm going to minimize the risk or the cost, as Mani said, the potential cost and complexity of setting up an LLC inside of your NIMCRUT. Well, if this were the old days and you had to ask your lawyer to draft your LLC, and then you had to find a registered agent to administer it going forward and pay your taxes and do the LLC's tax return, that would have been a hassle. That's all baked into what Valur does. We handle literally everything on the trust side except for deciding how to invest the money. That's your job. And so this is all invisible. And so Mani said he doesn't like to talk about things having no risk. I'm a lawyer. I'm even more averse to saying something is risk-free. This is something where, at least when it comes to cost and complexity, Valur completely hides that, and you don't have to worry about it at all. So again, if you believe in the structure and the logic makes sense, there's very little reason not to do it. I'm gonna take a couple of quick questions before we go to the case study with about 10 minutes left. Loic, good to see you again. You asked, is Valur set up, I assume, to accept private business shares in a CRT or NIMCRUT? Absolutely. This is probably half of all of the CRUTs that we do is either small and medium businesses or startup equity. We have processes in place to transfer these shares, to value them, to administer them going forward. There's really no question and no need to belabor that further. Mani, I'm going to put, I always hesitate to just put questions up here without an answer in mind, but I want you to talk about this, and I'm sure we can get Alfred an answer. What type of assets does this make sense for? I think broadly speaking, the Spigot NIMCRUT, the answer is assets that are potentially going to create liquidity, right? They're going to have income events and therefore would be distributed out of a NIMCRUT, right?
Yeah. So at the core, CRUTs make sense for appreciated assets. And so this is where it's kind of like my general rule of thumb is probably want something that's appreciated 3x. So it's appreciated assets. This is the core thing. And you don't need the money upfront. You don't need to sell the asset and spend all the money right away. That's when CRUTs make sense. Now, the types of assets, in most cases, it works for everything. We see everything from most common things, as Jeff said, is businesses, private shares, public stock, crypto. We see collectibles. We see art. Really any appreciated asset. Now, there's a couple nuances that I think, Alfred, you called out here is we see C Corps, every couple of days that are put in here. S Corps have one additional complexity. When you put an S Corp into a charitable remainder trust, it converts it to a C corporation. So that's fine if you're selling the business and the buyer doesn't care if it's C corporation or if you're doing an asset sale, it doesn't really matter. The general things you just have to check with your accountant are there any adverse tax consequences of converting the business from an S Corp to a C Corp? Charitable remainder trust, it just automatically converts due to kind of IRS rules there. So that's the one nuance there. The other one is with real estate. You can put real estate into charitable remainder trust. We see this all the time, but the real estate cannot have any debt left on the asset. So that's kind of the important,
Yeah, that's right. And just to tie a bow around it, Mani is right. Basically, any asset can work here. It's absolutely the case that if you're thinking about this, if you own public stock, if you own startup equity, if you own crypto, these are the most common and really the easiest, the lowest hanging fruit. There's no blocker here. It can make a ton of sense. It's very easy. If you've got some of these more complex assets, we can absolutely do them. And Valur is set up, and we do them all the time. It just adds a little more. And I'll put in a plug here for if you have any question about this, if you have a complex asset, or even if you don't, you just want to think about this. A major benefit of Valur being super efficient is that we have the time to spend with you. And so if you want to schedule a call, we'll spend half an hour and go through every detail of this with you personally. So don't hesitate to do that. And then going back to the questions, just to check off the last couple, Jawad asks, if you sell and invest the proceeds into another investment, is that income? And this is, I appreciate this question because it's the most important aspect of a charitable remainder trust. It is tax exempt. So if you sell an investment inside of a CRUT and then reinvest the proceeds without distributing, it is not income. At least it's not taxable income. I don't want to use this.
Sorry. There's a difference of distributable income versus not. So let's take the analogy of, let's say you have NVIDIA stock, your cost basis was $100,000. It's worth $1 million. You contribute it to the charitable remainder trust, and then it's sold at $1 million, same value, and you reinvest it into the S&P or Apple stock, whatever. If you had a NIMCRUT, there's no distributable income from that because the value contributed to the trust and the value you sold it are the same thing. Now, let's say on the other hand, you contributed and it's worth $1 million. NVIDIA does earnings reports and it's now worth 1.1 million, and you sell it at 1.1. Then there's $100,000 of realized, let's just assume long-term capital gains that could be distributed if it's a NIMCRUT. Now, if it's a standard CRUT, that would all be considered long-term capital gains, and when it gets distributed, there's a slight difference between what's distributable income. The distributable income is essentially growth above the contribution value.
Okay. Mani, I want a 15-second answer on this one before we get to the case study because we're almost out of time, but this comes up a lot, so I wanted to raise it. Can stock options be moved into a CRUT?
So let's say we're talking about options on Tesla. Answer is yes. If it is options from a startup that you haven't exercised, then the answer is no. If it's options from a startup, you need to own the shares and exercise them. If it's stock options, calls, puts that you've bought in the public market, yes, you can do those.
13 seconds. Well done. Before we get to the case study, this is a really important chart. I think we've talked about when they make sense. Very quickly, comparing the formats. What we've done here is make a chart that I think captures the two most important variables There are more, and we can talk about them. But what we've done is chart here all of these different structures on the axes of total returns on the bottom on the x-axis, and how much control you have over when the money comes out of the trust on the y-axis. And you can see in the top left corner a regular taxable account. You have complete control over the distributions. You can sell your stock, assuming that it's liquid. You can sell, you can realize, you can pay your taxes, and then you have the money. That's great, but the returns on our modeling are much, much lower. A standard CRUT, moving along, is much lower on the control over distributions variable, right? You have almost no control. You have control in the sense that you can reinvest and grow it, but at that point, you're forced to take out when you take out. But the returns are substantially higher than a regular taxable account. And then moving up the chart here, NIMCRUT and FlipCRUT, we put these kind of together. A NIMCRUT does give you more control than a FlipCRUT. A FlipCRUT maybe has slightly higher returns. It depends on the features and how you model this, and we can do another whole presentation on FlipCRUTs. But they're really similar on the return front. NIMCRUTs give you a little more control. FlipCRUTs a little more certainty, which would probably be the third axis.
I'd say the big difference is when does it flip? That's going to drive the return.
Yeah. And then, as you see in the upper right, Spigot NIMCRUT, slightly less control over distributions than a regular taxable account, in the sense that if you don't have the income, you can't distribute. But if you do, you have a choice. And then Spigot NIMCRUTs are, as you'll see in a couple of slides, have really by far the highest expected overall after tax.
Yeah. And the part I want to say is, like, a taxable account can make sense to sell appreciated assets. This is where the control piece is. Like, if you need to spend the money right away, or may have in the first couple of years something that takes a lot of capital, that's when that makes sense. And this is where it's like, you can't have your cake. And if you need the flexibility to spend the money, you may have to pay the taxes, and that's what you get, is flexibility by paying the taxes. If you're willing to give up some of that flexibility, that tax deferral, this is where you create more after tax returns. There is some sort of trade-off, and it's, do you need liquidity and flexibility? And the answer also isn't 100 or 0. We have plenty of people who they're selling public stock, private stock, and they'll put 50%, 80% in one way or the other based on that. So there's a way to also blend these things.
Or, by the way, they'll do two CRUTs. They'll do a standard and they'll do a Spigot NIMs. They have some regular income and they'll have some that they can grow for a long time, right? Very flexible. And because Valur's low cost and doesn't charge anything to set this stuff up, by the way, you can do that. Really quickly, I think we've covered this, but when do Spigot NIMCRUTs make sense? It's the kinds of things we've been talking about. If you're funding with illiquid assets, that will at some point have a realization event that you don't control, you might want a spigot to shield that income from distribution. If you're really just trying to grow the money and you're not worried about pulling the money out of the short term, or even to put it more strongly, you really don't want the money in the short term and you want to grow it over the long term, a spigot can make sense. If you're reinvesting the proceeds after the sale of the initial asset in cash flowing investments, or investments that'll require rebalancing, selling, diversifying, and realizing income, the Spigot NIMCRUT can shield that income from distribution. And then similarly, if you're looking to push this off for a long time until retirement or another future date, the Spigot is a way to retain control and push those distributions out. That's the bottom line, right? Monty, before I turn to the case study, anything you want to add here? I'm kind of speeding toward the end.
Yeah. The one piece I want to add is and you kind of hit on this, is what does Valur do? I was just seeing that is Valur, one, we do a lot of content. We have calculators, tools, and we can show that after this case study. We help people understand what are the best practice structures to help you reduce taxes, whether it's ordinary income, capital gains, estate taxes. We help you understand the value, trade-offs. We do calls. We have a lot of content, but we also help you access these structures for free. There's no legal costs. There's no upfront costs. And then we have flat annual costs to manage these structures. It's unlimited support, take care of, as Jeff mentioned, everything but the investments. So.
That's right. Really quickly, we scheduled to go to 2:45. We'll stick around for a few more minutes if people can. If you can't, you're going to get a recording of this afterwards, and we always put it on our YouTube channel anyway. So don't worry about it if you have to take off. There's our YouTube channel. Like and subscribe. Smash that button. The case study that we have here is, as I said, a very common kind of an avatar or ideal client profile. Someone in their 40s, based in California, selling some very highly appreciated stock. Here we're modeling a $2 million sale with a low cost basis. They probably bought their Tesla stock in 2011, or they have startup equity that's gone public. And they're expecting to reinvest their assets at a growth rate of kind of 8% a year. That's historically maybe average or even a little bit low, but a good growth rate. And the goal, as with most of our clients, is they want to diversify out of this concentrated position in a way that doesn't just obliterate their position via taxes. So what do you find if you look at these different structures? There's a lot on this slide. Don't feel like you really have to read it. The point is they sell the $2 million of stock up front and reinvest in a diversified portfolio. And they rebalance every few years, take some dividends every year. They sell and rebalance at years 5, 10, 20. But otherwise, they're trying to put off the liquidity as long as possible, which, as we said, is the use case for a Spigot NIMCRUT. And what you find here, and we'll talk through the logic, but top line, what you find here is that if you take that $2 million and you invest over this person's lifetime, another 40 plus years, with no trust after taxes, you're going to end up with about $26 million. That's great. 2 million turns into 26. That's fantastic. It's a very long time horizon. But you can do better. With a normal NIMCRUT, taking distributions when you have those dividends, taking distributions when you have that rebalancing every 5 or 10 years, still you do much better, $36 million after taxes over the long run. And this, by the way, assumes that you take those distributions and reinvest them. But then, again, you can do even better. If instead of taking those dividends out every year, instead of taking that rebalancing proceeds out every 5 or 10 years, you leave it all inside the Spigot NIMCRUT, you get even more compounding and even more growth, and you end up with $41 million after taxes. Like Monty said, we've done the hard work. There's a behemoth of a spreadsheet model and a bunch of code that goes into what we're showing you right here. Schedule a call if you want to go deeper on it. We don't have the time now, but I think you can understand why this is the way it is and why the numbers point the way they do. A NIMCRUT allows you to defer taxes as compared to doing nothing, and a Spigot allows you to compound and shield that money for even longer, and that's why they perform the way they do, right?
Yeah, and I'll say, Jeff's, we have our calendar link in the comments, so if you want to set up time to do that. We'll also, we'll stick around here for a couple more minutes. The broad idea is, again, this all makes sense. The more you defer taxes, that money that would have been lost to taxes is going to compound and create more wealth. You get the majority of that. Some of that goes to charity. That's the broad idea here. Let us know if you have any questions. One piece out, and I'll just quickly show how to use our tool here, so you can kind of run these numbers yourself or customize it to your situation. So let's get here. So this is our calculator. This is free to use. We'll share the link in the comments as well, and it'll be in the email that follows up. You choose things. How old are you? This is what we use to assume how long the trust will last, where you live. Taxes are different. You can take the cost basis, expected sale value. You can assume growth. We can have 8% here. And from there, we kind of assume, and then of what are the returns. And you can adjust how do you want this to set up for. And so if you look at this, this is setting this trust up for multiple lifetimes, and the payout percentage is 5%. Versus if you do it just for a 40-year-old's life, you see this payout rate change, and these numbers change as well. Now, you can adjust these things, the flip CRUT, standard CRUT, do all these adjustments. If you want to see the NIMCRUT, you can obviously do these numbers here. If you want to replicate the Spigot NIMCRUT, all you have to do is just put all the growth into capital gains and dividends. We'll roll out a model where this is controllable from here. And then you can adjust, and you can do this in NIMCRUT, adjust what is your preferred withdrawal. So right now we have it as 35,000, but you can adjust this for any year and control when you take those distributions. And that will allow you to, if you go back to these, you'll see these numbers change. And what is the impact? This really shows what is the impact of a Spigot NIMCRUT of when you defer even that 2% of distributions and yield in this case.
Monty, I've been doing this a bunch lately with clients, including many of the folks on the call here. We need to do a Spigot version of this model, because what you're showing here as a Spigot accurately models the Spigot NIMCRUT, but it actually overstates the benefit of the no trust scenario here, because you're shielding the no trust from distributions too, which is not realistic in the real world, where you're going to be forced to distribute out of and pay taxes in a no trust scenario. So everybody should play with this. In general, this is a sophisticated model, very correct. We're going to roll out a Spigot version of this very shortly, and you'll be able to play with it.
And the last I'll call out here is there's a great question from James. We probably do a bad job talking about what we do and our costs and all those things. But I will say, again, there's no upfront cost. You can chat with us for free. We have these tools, the calculators, content, these webinars, all those things are free. We provide the trust documents. There's no cost to that, no upfront cost. Help you transfer private shares, public stock.
And I have to be very clear. We do the drafting for free. We set up your trust all the way from idea to you've got a final trust notarized in hand with the assets transferred, which you would have paid a lawyer a bunch of money for. You pay us nothing.
Yeah.
And then
we take care of all the trust administration, from getting the EIN, take care of the annual tax filings, accountings with the trust, unlimited support of how to control these distributions, when to take them. And that's typically flat $5,000 flat per year. So
right.
No upfront costs, and then a flat $5,000 per year.
Yep, that's right. That is, I'm going to put the slides back up here. We can call it there. Any other questions, chime in quickly. Otherwise, as we said, you've got our email addresses here, Monty and Jeff at Valur.com. You can always schedule a call. Just go to our site. There's a button in the top right corner. There's a link there. And then at the very least, check us out next time. A week from today, we'll be talking about QSBS stacking, which is I guess a close cousin of CRUT planning. CRUTs are involved. This is specifically for early stage startup equity, which is a kind of a subset of what we're talking about here.
So, and the teaser there is, so if you have appreciated assets, CRUTs typically are the best way to defer or minimize capital gains, unless you have a specific type of asset. Typically, as Jeff said, it's typically for people in the startup space. It's a government incentive. We can completely avoid taxes. CRUTs allow you to defer taxes and take care of compounding. QSBS, if your equity is eligible, allows you to completely avoid taxes. And QSBS stacking is how do you keep maximizing that. And then after that, the next webinar, 2 weeks after that, on private placement life insurance, which is a very, very unique type of insurance that's mostly an investment vehicle inside of a tax wrapper. So
that's right. Maybe a little more geared toward estate planning and the slightly higher net worth band. But again, Valur aiming to bring it to a much broader part of the population. So we'll be back to talk about those. Appreciate you all joining this time. Great questions as usual. And we'll see you all soon. Thanks.
Take care, everyone.